Welcome back to Online Trading Summit. In this video, we have Jed Mojica sharing with us how he used quant and visualization techniques to identify momentum stocks. Jed is an independent portfolio manager and a founder of BOH Society, an online community of Filipino stock investors based locally and abroad. In his presentation, Jed talked about using relative performance method to pick the leaders for momentum trades using a scorecard and visualization chart. It's a very interesting angle to stock picking, so make sure you learn as much as you can from Jed's techniques. Hi Jed, welcome to the Online Trading Summit. How are you doing today?
Very good. Thanks for having me.
Yeah, thanks again for welcome you to the online summit, and thanks for taking time off to share about your trading experience and your trading expertise with the summit participants. I'm very sure you are going to be providing a lot of value to the participants. But before we start and let you go ahead and present what you want to share with the participants, I thought it might be interesting for us to have an understanding about your background, how you got started in trading in the first place, and how did it evolve into what you are doing today. So maybe would you just like to quickly share with us about how you got started in trading and how it evolves thereafter for you?
Right. Well, my story is a bit weird in the sense that I started studying about the financial market when I was still in grad school, and I did a lot of research work, academic research on financial markets. And after that, I started to get into understanding how financial markets move. And then I got this opportunity to become a research head for one of the oldest investment banks in the Philippines. And that's how it all started.
I see. And when you first started on that, was it more like a fundamental value investing kind of a model, or was it straight away into technicals and tradings and quant straight away?
My background is in economics, so most of the way that we approached it was more from a macro point of view. So that's really my base, being a global macro analyst first before I got into the technical side of things.
I see. So would you mind sharing a bit more how you got into the technical side of it?
Right. When I was the head of research at the investment bank, one of the things that they asked me to do was to put together a proprietary desk. They wanted to put up a desk for equities, and they wanted me to go through the materials, go through the research, go through the entire process of setting up the desk. Once I was able to put up the desk, I started to get into the various aspects of various investment process. From stock selection, portfolio construction, trade planning, execution. And eventually from there, I started to find my expertise, where my strengths were. And I became more interested in the quant side of things, the technical analysis side of things.
I see. So it was really by chance that you got into knowing about technical analysis because you were required to set up the desk.
Correct.
Oh, that's very interesting. That was actually pretty similar to how I got started in the world of trading and technical analysis as well. So today you wanted to present on this topic about momentum-based trade selection workflow using quant models and data visualization. Wow,
right.
That sounds really sophisticated, or is it something that I'm just overcomplicating the whole process? How do you decide that this is the topic you want to talk about?
The title's quite sexy because I made it sexy, but the approach is really very simple. The approach was really developed while I was a portfolio manager at one of the largest asset management firms in the Philippines. For the longest time, portfolio managers in the Philippines were focused on studying fundamentals, company fundamentals, knowing who to talk to, getting relationship with top management of various firms. And that's how they derive their information. But after the global financial crisis, when foreign managers started to come in, there was a shift in their approach, and it became more quant-driven because they wanted to develop some type of edge, and that's where I was involved in the kind of research that we put into our process, into quantifying our process. That's how everything started.
I see. I'm really very excited to hear what you've got to share about this quant models and data visualization. So I'm going to hand over the stage over to you right now, Jet, and so just go ahead and share with the summit participants what you have prepared for them. All right.
Right. Hello. So welcome. My name is Jet Moika. I'm the founder of BOH Society. Tonight I'll be discussing my workflow, and how I use simple quant models and data visualization techniques to identify stocks, trades with momentum. Now, everything that I will share tonight is the product of having been a portfolio manager at one of the largest asset management firms in the country, where we extensively applied our models trading Philippine equities. But increasingly, over the past couple of years, we've also applied these models to Forex, US markets, and most recently to cryptocurrencies. I've been working with retail investors over the past 4-5 years. And one of the things that we teach our retail investors is to always focus on buying leaders and selling laggards. And this idea was really a product of William O'Neill's research and was published and popularized in his book, How to Make Money in Stocks. He's the founder of Investors Business Daily, and they specialize in relative strength rankings where they map out leaders and laggards and then publish that research to their subscribers. Now, one of the things that I realized working with retail investors is that a lot of their effort when they first get into the market is spent on market timing. What this means is they really focus on developing and finding trading systems, going through the trading system, trying to find trading systems that fit their profile, that fit their investment time horizon. And at some point, they're able to develop rules for risk management and identifying profit objectives, which then they use to generate ideas and execute on their trades. So initially, at the start of a retail investor's journey, the focus is really more on finding how to buy stocks and how to sell and manage the trades accordingly. To put it in another way, a typical trading system that follows the trend uses a 50-day moving average, for example, defines the strategic bias for a trade in terms of the 50-day moving average. If price, for example, is above the 50-day moving average, the bias is bullish. If something is below the 50-day moving average, then the bias is bearish. And that's how they filter through their investment universe. So they prioritize stocks that are above the 50-day moving average, and they tend to stay away from stocks that are below the 50-day moving average. And then they use the crossover rules around the 50-day moving average to generate their buy and sell signals. So to put it in another way, whether you're a retail investor or a institutional portfolio manager, you'll have access to data such as price, volume or flows. You even have access to commitment of data, commitment of traders, positioning. You also have access to financial information. You have access to economic data that can play a role into your investment process. Now, basically, from that data set, you get to define your investment universe, and you apply your technical filters, the things that you develop through your trading system, as your initial filter. So for example, when your price is greater than your 50-day moving average, that already takes out a chunk of the stocks or securities in your investment universe. So you tend to prioritize those securities that are above the 50-day moving average. You then put that through your technical analysis framework, your trading system, and then you try to generate buy and sell signals based on that initial filter. So a typical idea generation workflow flows from the data, your investment universe, you carve out a subset of that investment universe, and then you try to run your buy and sell filters through your trading system. And then you generate a watch list. Now the watch list has already narrowed down the stocks or securities that you're interested in. And from there, you try to trade, you execute your trades based on your market timing system. Now, basically what I've just discussed to you is that there are certain models that will make you act on your trades, and there are certain systems that will make you look at your trades. What I'm trying to tell you at this point is that if you're following this type of workflow, what you're basically doing is putting too much strain on your trading system. You're asking too much out of your trading system. You're asking your trading system to not only define the kind of stocks that you're going to trade, but you're also asking your trading system to tell you when to buy them and when to sell them. And in our experience, there's a much better way to go about this entire process. And I'll be discussing this point to you in this presentation. So in this presentation, I will outline my preferred systematic approach to trading momentum-based stocks. We always hear people talk about momentum strategies, but we don't really hear about their workflow. We know that we should be focusing on leaders and avoiding laggards, but we don't really know how to go about it systematically. Whether trading equities, currencies, commodities, or cryptocurrencies, the preferred way is to always trade with a trend. But for whatever reason, retail traders struggle with the concept. The other way to think about it, is in terms of momentum or the rate of change of price over a specific time horizon. So my agenda for tonight is to first share with you my momentum strategy workflow, and then discuss ranking models and data visualization techniques that can help you optimize how you pick stocks, how to pick trades. And then finally, if we have time, I'm going to introduce to you a framework on momentum efficiency. Again, what you will realize, your main takeaway from this presentation is that there will always be models that will make you look, and there will be models that will make you act. Retail investors focus too much on models that make them act, rather than focusing first on the selection process, the trade selection process. So what is momentum? Momentum in tonight's discussion is not about the momentum measured by your technical indicators. So I'm not talking about the RSI. I'm not talking about the MACDs, stochastic, and what other technical indicators that are available in the market. I'm talking about something more basic. I'm talking about the rate of change of price over a specific or specified time horizon. So I'm going to define various types of momentum metric that we can use, just so we can have a similar language for them. So 12-month change, what this means is you're comparing the current close against 12-month close and translating them into percentage terms. Year-to-date change, you're comparing the current close against the first day of the current year, and again, doing the same transformation. 3-month change is rolling. You're comparing the current close against the 3-month close. 5-day change, current close against the 5-day close, and then the 2-day change is the current close against 2-day previous close. So that's basically the momentum measurement that we're trying to capture. So what are momentum strategies? Now, a typical momentum strategy ranks securities by their 12-month change and buying the top 30% performing securities and selling the bottom 30% securities. So it's a ranking mechanism. So if you have 100 stocks, and what you're basically doing is getting their 12-month change, rank ordering them from the highest performing security to the lowest performing security and carving out the top 30, buying those securities, and then selling the bottom 30% securities in that ranked list. In my experience, a more simpler momentum strategy to ranking securities is by their year-to-date change. What we've found is that the returns and the rankings tend to be more stable and they generate higher returns than just using a 12-month rolling metric. You can tweak the ranking methodology, shorter, longer duration, to better capture your trading style and investment time horizon. But the point here is to be able to organize the data in a systematic way. And there is nothing more systematic than ranking things based on their actual performance over a specified time horizon. There are other advanced ranking systems, but the above strategies will help us get started, which is really what's lacking in the investment process of majority of retail investors. In my years of working with retail investors, seeing how much time they spend on market timing, they tend to forget the other component of portfolio returns, which is about trade selection. So they're putting too much strain on their process using their trading system to select trades and to execute on trades without them realizing that they can actually optimize trade selection if they use a completely separate model from that of their trading system. So let's get started. So first thing we're going to discuss is ranking securities based on year-to-date returns. What are the advantages? What will you see? What are the insights you will gain from ranking securities just by looking at the year-to-date returns from the start of the year and refreshing the model every month, every week, every day, just to see which leaders are emerging. So in this slide, I'm presenting to you the top 10% and bottom 10% of NYSE and NASDAQ listed companies. Here, what you can see that over the past year, ETSY generated 94% return during that period, followed by SQ, AMD, SYNP, ESND, and the likes. Most of them are generating in excess of 75% return for the year. You would think that a lot of investors are making a killing today in the US market, but you still hear horror stories of how retail investors are not doing well despite the bull run in US equities. On the other hand, you can map out things that you should be avoiding or things that you should be shorting. These are the bottom 10% of the NYSE and NASDAQ securities. So RENN, UTM, CYOU, WIN, SUPV. These are stocks that are fallen by more than 50% over the same year-to-date period. So from here, you can already see which stocks would have generated you a lot of alpha, which stocks you should have prioritized over the past year. One question that I always get asked is, we know this today, but did we know that these were going to be the leaders at the start of the year or 3 months into the year and whatnot? And basically, the framework that I'm suggesting will tell you that these are the same leaders that were able to generate returns over the first 3 months of the year, and that had you been focusing on tracking the year-to-date performance of all the stocks in the universe, you would have been able to cut these types of leaders. You would have been able to prioritize some leaders and selling the laggards. The other thing that you will realize is that even today, when you're just focusing on the year-to-date returns of the investment universe, what you will realize that when you pull up the charts of these stocks tend to be the ones that have beautiful trends. They're the ones that have well-defined entry levels, well-defined momentum, very sustainable up moves and whatnot. as opposed to those stocks that are underperforming. They're the ones with terrible charts, clean downtrends, things that no one would have bothered touching given the kind of decline that they've had throughout the year. So EPSY startup, basically what I'm showing you here is that at every point, at every stage here, there were entry points that would have allowed you to catch that 94% return in EPSY had you been paying attention to this stock that was leading on the leaderboard of NASDAQ and NYSE companies. Another company that you would have probably had an opportunity to catch, SQ, not as clean as EPSY, but still, had you been tracking the performance compared to the other stocks in its universe, you too would have been able to catch this trade. One trade that I wanted to highlight in this presentation is HLF. If you had run the year-to-date filter mid-February, you would have realized that it was already part of the top 20 stocks outperforming the investment universe. The stock was up 23% mid-January, mid-February, and then it was able to generate another 25% over the next 3-5 months had you simply been focusing on the stock. As of end July, the stock is up more than 53%. And then again, if you look at this filter that I included in the slide, what you'll see is that there are other winners that you would have been able to catch here. Names like Netflix, Twitter, Wix, SQ, YNDX, and the likes. So those were the stocks that were early leaders on the first 2 months of the year, and they continued to outperform over the next 7 months after this initial screener. The other thing that I wanted to highlight is that once you have a ranking model, similar to the year-to-date return that I'm showing you, you can then overlay what you've learned about your trading system and apply the rules that you use on your trading system to generate buy and sell signals based on the prioritized list. So you have a list, you run your trading system filters on that smaller list. So you get to prioritize which stocks you get to enter following that ranking model and then executing based on your trading system. So the question that I always get asked is, how will you know that the momentum leaders that you filtered during the first, using your year-to-date approach, how do you know that they will continue to be the ones that outperform the market for the remainder of the year? Now, the way we did it in the Philippines is that we were able to do some research and we were able to tie the performance of various stocks against their market capitalization. So basically what the study showed is that you need to first know the kind of market capitalization, the security of the company, of the security. Once you know the market capitalization, you can have benchmark returns give per bucket of market capitalization. So in the Philippines, we have micro cap stocks. These are companies with market cap less than $60 million. Small caps, less than 200 million, but greater than $60 million. Mid caps are stocks that are less than 1 billion market cap, but greater than 200 million market cap. And then you have the large caps. These are stocks that are greater than 1 billion market capitalization. Again, in our experience, when you speak of large caps in a bull market, on average, they can generate for you in a year anywhere between 10% to 30%. In the Philippines, we have 30 large cap index stocks. These are stocks included in the PSEI benchmark index. And basically, those 30 stocks can generate anywhere between 10 to 30% for you year to date. But then there will be 1-2 stocks in that basket that will generate excess of 30%. They can print anywhere between 50 to 70% for the year. But those are exceptions, and there will always be one or two stocks that will be outliers within that basket. On the other hand, if you drill down, mid caps can generate anywhere between 30 to 100% per annum. Small caps can generate anywhere between 100% to 200% per annum. And then finally, micro caps can generate anywhere between 200% to 400% per annum. Again, in our experience, per bucket, there will always be outliers. There will be stocks that will defy these benchmark returns that we've carved out over a 9-year study. There will be stocks that will break that 400% return per annum upper limit for micro caps. And those stocks will tend to be unicorns. They'll generate 1,000% return once they break that 400% per annum upper limit that we've tracked. Again, this is the case for the Philippines. It will be different for US equities. It will be different for Forex and whatnot. But the point there is you will be able to generate some type of benchmark for market capitalization if you're trading equities. You just need to look into it. Again, the year-to-date approach can be applied in different asset classes. So for example, if you're trading FX, if you rank FX in terms of year-to-date returns, you're following anywhere between 20 to 35 FX pairs. Right now, if you look at this table, what you'll see is that the best performing currency year-to-date is the US dollar, Turkish lira. The Turkish lira sold off by more than 29%, so you would have been up 29%. It's an extraordinary circumstance given the situation in Turkey and how everything there is affecting the currency. If you drill down a little bit, what you realize is that the sell-off in Turkish lira filtered through some emerging market currencies like the Indian rupee, the South African rand. These are the other two worst performing emerging market currencies. And then you can drill down the line. So on the other hand, you can flip it. You can look at which currency pairs were underperforming year to date. So right now, silver is followed by the Australian dollar, Japanese yen pair, and then gold, and then the US dollar, Mexican peso. But the thing here is what you'll realize is that even though the Mexican peso is down 5.73% year to date, at one point it was actually one of the currencies that was affected by what was happening to the Turkish lira. It was also being affected by the strengthening of the US dollar. So what do we know from this table? You can basically tell the story in 4 bullets. Emerging markets badly beaten by a strengthening dollar. Commodity currencies have been hardest hit by the appreciation of US dollar and Japanese yen. So the leaders for the year has been the dollar and the Japanese yen. And the rest of the crosses have been range bound, have been choppy this 2018. So the insights alone from doing these types of rankings will help you prioritize on what pairs you should be running your trading systems on. No need for you to run your trading filters on all 35 stocks or on all 35 FX pairs. You can actually carve out just the top 30%, for example, and the bottom 30%. So you should be long the top 30%. So Turkish USDPRY, USDINR, USDZAR, EuroSEC, USD CAD, up to EuroCAD. Those are the things that you should have been long on a year-to-date basis. Bottom half or bottom 30%, you should have been short odd. You should be short silver, AUDJPY, gold, USDMXN, and the likes. So again, year-to-date rankings, carve out top 30%, carve out bottom 30%, focus on them. That would already help you prioritize which ones you should be trading. Again, similar to what I showed you earlier, these things don't happen overnight. The USDPRY did not go up 29% in one go. It was a steady uptrend in USDPRY, and you can see it in the chart of the USDPRY. And that's the thing about it. When you're doing your rankings, the rankings are forcing you to look at charts that you would not normally look at, and that helps in identifying where the opportunities are. Now it then becomes a function of your trading system, how you're going to execute on those specific opportunities. So again, the year-to-date, just to summarize, the year-to-date scorecard approach helps us do the following things. First, you need to realize that all securities reset to 0% at the start of the year. In short, it's a level playing field, and any security can be a momentum leader from a year-to-date scorecard approach. The scorecard approach is very useful, specifically during the first 3 weeks to 3 months of the year, because it's very easy to track the performance of all the securities in your investment universe, and identifying leaders and laggards becomes super easy during that window. The premise of the year-to-date approach is that once a security has an established trend, specifically over the first 3 weeks, that trend during the first 3 weeks will allow you to generate returns over the next 3 months. Now, it becomes tricky after the third month, because then you need to contend with momentum rotation. That's when you need to start using more sophisticated models than the year-to-date scorecard approach. But the year-to-date scorecard approach still helps you define the bias for all the securities in your universe. You just need to tweak your approach and add a little bit of complexity so you can capture the momentum rotation across your investment universe. So what kind of tweaks, what kind of modifications can you apply on your year-to-date scorecard approach? One thing is you can inject a shorter duration rate of change. So something like a 3-month percentage change can help you enhance the analysis, can help you enhance the trade selection process. So for example, in this slide, what I'm basically showing you is that you can actually have your year-to-date returns, you compare that with your 3-month returns, and then you try to identify the themes, the stories, and the momentum within your universe. Basically, what you can see here is that the Turkish lira, it's up 29%, but it generated its return over the past 3 months. So it's still strong. It's still the strength of the Turkish lira, of the dollar Turkish lira, is still cascading over the past 3 months. What you'll also see in this chart is that even though, for example, if you compare the year-to-date change in your Swiss franc Japanese yen, that pair is down to minus 2.89% year-to-date, and it's one of the worst performing pair this period. What you will see is that over the past 3 months, CHF-JPY has actually been rising. So if you were trying to counter trend the pair, you would have been able to capture that 3-month return despite the minus 2.89% decline in the CHF-JPY. And then you can try to come up with the other stories for the other trade. So what do we know just by looking at this table? It tells us that dollar strength strengthened against base metals, British pound, and the euro over the last 3 months. But that the dollar strength has no longer been able to push down commodity currencies like the Aussie, NZD, and the CAD over the same 3-month period. So whatever weakness we saw on Australian dollar pair, the NZD USD pair, and the USD CAD pairs. That happened earlier in the year, but they're no longer selling off right now. They're actually range bound if you look at this table here. So those are the kinds of insights that you can that can help you identify potential trading opportunities. The other thing that you'll also realize on this in this table is that earlier I mentioned that the year-to-date leaders have been the US dollar and the Japanese yen. But if you look at the 3-month performance, the Japanese yen is actually no longer appreciating. It's actually weakening over the past 3 months compared to the first 3 months of the year. So there was some type of counter trend opportunities trading JPYs. You could have been selling JPYs instead of buying it like you were at the start of the year. Again, this story wouldn't be as apparent had you just been looking at technicals, had you been just looking at charts and running your filters to generate your trade ideas. Rankings allow you to define trends, to define momentum, to define themes over specific time horizons. The other way to think about this is when you're ranking things, basically what the rankings forces you to do is to focus on the extremes, and it's the ranking model also tells you to ignore everything else, to ignore the middle part of the table, so ignore these sets of trades, because usually the pairs that are trading at the extremes, they tend to be the ones that have stronger moves. They tend to be the ones with better looking charts and whatnot. This isn't to say that there aren't any opportunities trading the middle of the pack, but what I'm saying here is that the easier trades tend to be the ones at the extremes of the ranking system. Then finally, one extension, the last extension that you can do is to incorporate various durations, percentage returns into your relative performance table. So we've already discussed how you can use the year to date. We've already discussed the 3-month percentage change. You can incorporate shorter durations like 1 month, 5 days, 2 days, and 1 day in order to identify opportunities. You can still sort based on the year-to-date return column, but then you start focusing on where action is, where volatility is, where momentum is. And the way I do it, if you're using this type of table, you're looking at colors these are conditionally formatted, that tend to highlight the values, the higher valued percentage changes. So in this particular table, what you'll see is that over the short term, if you're trying to go long certain currency pairs, you would have been better off being long this set here, the green set, the pairs with the green highlights. So euro dollar, GBP, the British pound, US dollar, CHF, JPYs, those would have been good counter trend trades despite their declines year to date. If you were trying to counter trend some of the leaders, you would have been shorting USD CHF over the past 2 days. It's been selling off a little bit. You would have been selling EuroSec despite EuroSec being up 4%. You would still have stuck with being long USDPRY given the performance over the past 2 days. So that's basically how you use a relative performance table that incorporates multi-duration returns and still ranking based on the year-to-date performance of those currency pairs. Now, it can be cumbersome if you try to look at the data in this manner. Not all of us can easily spot where the opportunities are just looking at the table like this, because there's too much information, and we really want to simplify how we choose stocks or choose trades. That's why it's very important that you don't limit yourself looking at these types of performance tables. It might be better if you start using data visualization techniques that will help you identify the best momentum opportunities. So let's discuss this aspect of our investment process. So basically, when you're using data visualization techniques, what you're really doing is looking for outliers. You're looking for things that stand out, that are able to differentiate themselves from the rest of the investment universe. Earlier, I mentioned that at the start of the year, everything starts out from zero. So if you plot things in terms of a scatter plot that compares a short duration and a longer duration, like a year-to-date percentage change against a 3-month percentage change, basically everything starts out at zero on January 1. And then as the day progresses, what you'll realize is that some stocks or some FX pairs will move in this direction. They start gaining on the first day, on the first 3 weeks, in the first 3 months, and those stocks will be the highest momentum trades that you can trade. They're the leaders of the pack. And then there will be those that will start lagging immediately at the start of the year, and you'll be able to track the evolution of the decline, of the downward momentum that they're exhibiting throughout the trade. The other way to think about it is currency pairs, stocks that move in this quadrant are stocks with momentum that are positive both on a short duration and longer duration. On the other hand, trades that fall in this area are trades that have negative short duration return but are still positive on a longer duration return. When you start seeing pairs in this quadrant here, these are pairs that are basically in a downtrend. They're not only negative on a short duration basis, they're also negative on a longer term duration basis. But then there will be pairs that start to improve, that even though they're still in the decline, in a long-term downward momentum, what you'll see is that the short duration is starting to improve, and you'll start seeing these pairs in this quadrant. To put it in another way, first quadrant is about leaders. Second quadrant is about leaders that are starting to weaken. Third quadrant, leaders. These are mostly laggards. These are pairs that you would tend to avoid, tend to short, and whatnot. And then you have pairs, trades that are starting to improve after being in a longer term downward momentum. So that's basically the framework that we're operating on when you start using data visualization techniques like a Scatterplot model. So to put it another way, what you will basically see if you keep reviewing how various securities move through a multi-duration Scatterplot return like this, is that your leaders, while they will have a longer duration of outperformance, at some point they will start to weaken. And when they weaken, you will immediately see how they're weakening over the short-term duration, even though they're still able to maintain their longer duration upward momentum. And then at some point, their upward momentum starts to give way and they start to lag, and it's really a cycle around the Scatterplot. Now, it's not necessary that all leaders will follow this type of circular flow. Some leaders that weaken are eventually able to go back up to being leaders after a brief consolidation, brief short-term weakness. So it's very important that for leaders that fall in this weakening quadrant, that they immediately go back up, or they're able to at least maintain their long-term momentum, that it stays positive. So here I'm basically presenting the entire universe for NYSE and NASDAQ securities, And here you can already see how Scatterplot is able to help you identify the outliers. Which stocks should you have been focusing on? When you're using this type of visualization technique, what you need to realize is that when you plug all the data in, you won't see all the names of this or symbols of the securities in the universe. And basically the framework is telling you is that if you cannot read the names, if you cannot see the symbols, you don't need to pay attention to them. You only need to pay attention to securities that are able to differentiate themselves. So in this particular example, I'm using a 3-month percentage change and year-to-date change scatterplot model. And in this model, the leaders are ESND, SVU, AMD, TRIP, and all the other names that are outperforming and that are able to differentiate themselves from this cluster. Names that you should have been avoiding are RENN, QTM, WIN, CYOU, and whatnot. It's basically the same story as told by the relative performance ranking tables that we were looking at right now. But now the story becomes richer because you're comparing short duration, longer duration, and you're visually able to see which are outperforming over short duration and which ones are underperforming over a longer duration. Easier to see, easier to prioritize. You just grab the outliers, run them against your trading system, against your filters, try to generate buy and sell signals based on a smaller universe. And that's the way you optimize on your trade selection based on momentum. Again, this type of approach can be applied to various asset classes because you're basically just transforming the relative performance information we were discussing earlier and trying to visualize things in terms of a scatter plot. So in this example, I'm comparing 5 days versus 1 month. And basically what this model is telling me is that if I'm trying to trade momentum, my best bet here would be to trade CAD-JPY, given that it's supported by both its 5-day momentum and 1 month momentum. And if I wanted to short something, my best opportunity would be to short USDMX and short USD-ZAR, short GBP CAD, and whatnot. So that's how I will basically use this scatter plot model. Also, if you look at USDTRY, you can see that it has outperformed on a 1 month basis, but then over the past 5 days, it hasn't really done much. It's been pretty much range bound compared to a pair like CAD-JPY. So those are some of the things those are the insights that you would gain from these types of model. So to put it another way, let's look at the chart of CAD-JPY. CAD-JPY sold off for most of the year. It's been range bound since March, and right now it's trading. It formed a higher low above 84, and it looks like it has a little bit more upside. And that story, I wouldn't have looked at CAD-JPY had the scatterplot model not tell me that there was an opportunity to trade CAD-JPY. And the thing here is, this is a daily chart. If you drill down to your intraday chart, your 1 hour chart, then it becomes clearer. The opportunity becomes clearer because then you can see the bias. The bias here is that you have a stock, you have a currency pair that's trading in a range. It's forming a base, looks like an inverted head and shoulder. So you put together a trading plan based on the setup on the hourly chart. Again, trade selection comes from quant models first, data visualization models first, and then you look at the chart. And then you try to apply your trading system based on what you see on the chart. So just to summarize, if you're going to do multi-duration analysis, there are certain combinations that you can use. My preferred combinations are 2 days versus 5 days, 5 days versus 1 month, 1 month versus 3 months, 3 months versus year to date. Now you can apply a multi-duration analysis on intraday data, but you need to have access to real-time data. Otherwise, whatever rankings, whatever scatter plot visualization that you use on intraday data will be just too tedious to maintain if you don't have access to real-time data. So far, all the models that we've been discussing have been using end-of-day data, and we can refresh that intraday. You just need to specify how you would like to refresh your information to capture the most recent data point. Now, I've already discussed my preferred multi-duration combinations. I just wanted to share with you that knowing what type of combinations, multi-duration combinations you can use, you can actually define the trading strategy for analyzing specific combinations, multi-duration combinations. So what do I mean? For example, if you're a scalper, if you're a day trader, and you're trying to trade momentum on given your preferred style, your best bet for identifying trading opportunities will be to use the 2 days versus 5 days. And then you just prioritize for momentum trades, prioritize those that are in quadrant 1. So right now, if you're going long and trying to scalp trades, it's end of July right now. Your best opportunities are in USDPRY, CHFJPY, and CADJPY if you're trying to scalp. If you're trying to short, you have USDMXN, but you need to zoom, blow this picture up so you'll get a better opportunity on how to trade the other opportunities. If you're a swing trader, you have a longer investment horizon than a scalper day trader, then you're better off looking at a 5 days versus 1 month chart. That's how you get to identify the best opportunities for you. If you're a trend follower and you're trying to buy into weakness into certain pairs, then your best bet is to look at 1 month versus 3 months and to focus on pairs that are sort of selling off or pulling back on a 1 month basis, and then but are able to maintain their 3 month trend. Position traders, on the other hand, your best bet is to look at 3 months versus 12 months, 3 months versus year to date, and because that's really where the big picture moves are. Those trends tend to be lasting and long living. So right now we can clearly see that emerging markets, even though on a short-term basis, some of them are cooling off, pulling back. The dollar is weakening a little bit over the past 5 days, 3 weeks. But generally, they're still able to maintain their 12-month trend. So there's still opportunity to go long on things like USD ZAR, USD INR, USD CAD, and whatnot. You should still have a short bias for silver, despite the recent bounce in silver, if you're a position trader. But then again, it really depends on your investment time horizon and your general approach to the market. So far, what have we covered? We've covered how to generate ideas using a year-to-date scorecard model. The model is very helpful in identifying leaders, laggards, and even themes. We've covered how to track momentum rotation using a multi-duration table and scatterplot model. We've also covered how scatterplot models are not just useful for momentum trades, but that you can actually use the visualization model to generate ideas regardless of your trading style, trading preference, and trading strategy. So it's not just about momentum, although I focus mostly on how to trade momentum using these models. I'm done with this section, but I also wanted to explore or introduce to you the concept of momentum efficiency. So let's discuss how I think about momentum efficiency. So right now, I've discussed momentum, and momentum is just basically your return. What I haven't discussed is how you can incorporate into the analysis into your workflow, the concept of risk. And risk we typically measure in terms of volatility. Now, what this basically means is that for me, even though the momentum-based approach, looking at scatterplots, looking at relative performance tables, are generally very useful. At the end of the day, for me, it's never just one thing. It's not just about momentum. You need to incorporate other factors that will be helpful in identifying the best opportunities for you, whether you're trading US equities, Philippine stocks, cryptocurrencies, or FX market. Again, it's never just one thing. So you need to widen your idea generation workflow. Your idea generation workflow shouldn't revolve around your trading system. It shouldn't just revolve around momentum. It should actually consider other factors. And typically, when you look at factor-based investing, you're not just looking at momentum. You're also looking at volatility. You're looking at quality. You're looking at liquidity. But for simplicity and for tonight's discussion, and in this last segment, I wanted to just focus on momentum and risk, momentum and volatility, and how you can use the information from a framework that uses these two factors to generate your trade ideas, to generate a target, a watch list, to generate a model portfolio that you can eventually use to execute on your trades. So let's discuss this. So what is volatility? Now, volatility is a measure of the variation of returns of a security over a specified time horizon. So here I want to show you how a typical security, high volatility security would move. It has a lot of swings, even though it's creating higher highs, higher lows, and it seems to be trending. But the swings are quite wide between peaks and throws, and that we don't like that in our portfolio. We don't like that too much if you're trying to build up a portfolio. On the other hand, you want things that are smooth things that are easier to trade compared to high volatility trades like this one. So in a low volatility trade, you will see a chart that's moving up. Swings aren't that pronounced, but the uptrend is well maintained, it's well behaved. So that's something that we tend to look at, or we tend to prefer. We prefer trades that are in an uptrend, that are not swinging too much. If you want to swing, on the other hand, if you're a swing trader, obviously you want to trade pairs that have high volatility. But if you're putting together a portfolio, you want a comfortable life. You don't want to mess around too much with volatility, but you want to capture the excess returns. You want to generate alpha for your portfolio, and you want to focus. Then you should focus on trades that are trending but have lower volatility compared to this first chart over here. Now, the way to think about it is in terms of the framework introduced by Mark Witz. He introduced the efficiency frontier, where he put all the individual securities in his investment universe in a scatter plot, and then compared their individual expected returns against volatility. Now, the problem with this approach when applied to stocks is that it's reliant on your estimates of expected returns. Estimates that are based on fundamental analysis, fair value estimates. And that's why operationalizing this type of model became very cumbersome for a lot of people. Imagine having 1,000 plus securities in your investment universe, and you're trying to come up with fair value estimates for all of them, just so you can apply the efficiency frontier, just so you can apply it in your stock selection process. What I've tried to do is I've tried to make the heroic assumption that instead of using fair value estimates, instead of trying to compute fair value and comparing it against current price and trying to see where the largest upside potentials were, I wanted to make that heroic assumption that instead of doing that, let's use momentum. Let's use a metric of momentum that's stable, that's predictable, that doesn't vary as much as that that can be reliable, and then use that as our proxy for expected returns. When you do that, expected returns becomes momentum, and volatility is still just volatility. And basically, that's what I did. And this is what a typical momentum efficiency frontier would look like. Because now, instead of looking at fair value estimates, I'm looking at measurements of momentum. Now, the way I compute momentum is proprietary, but you can use year-to-date return just to see how it'll all map out. The important component here is that we're introducing volatility into the framework, and that you'll be able to derive which individual securities are efficient, which ones are not, which securities you're being rewarded for the risk that you're taking. Remember, the relationship of risk and returns is non-linear. Just because you're taking risk, it doesn't mean you're going to be automatically rewarded. Some people have this, especially retail, they tend to believe that the only way for you to generate excess returns is to take on more risk. But when you plot things in terms of the momentum efficiency frontier, what you'll come to realize is that even though you're taking on so much risk, you're not going to be automatically compensated by momentum. You're not automatically going to be compensated by the kind of risk that you're taking. For example, you have stocks like WIN, QTM, SAEX, REN that have volatility, annualized volatility in excess of 90%. But your general momentum metric, based on the way I measure momentum, it's less than 10% based on this metric. You can actually choose better options if you're trying to trade a stock with volatility close to 70% by moving up this vertically. So instead of QTM, for example, if you want a stock with similar volatility, you'd be better compensated if you focus on ESND. You'd be better compensated if you focus more on ETSY. And even then, if you wanted less volatility, but you wanted the same type of returns or better momentum returns, then you're better off moving leftwards where there's higher reward. You're more rewarded with momentum. Trades like SYNTM, PRMW have lower volatility but higher momentum returns. AMD, one of the outperformers this year. Same profile as PRMW, but slightly more volatile. So it really depends on what you're trying to capture. Are you trying to capture more momentum? Are you trying to capture more volatility? But the point here is you'll be provided with this type of options by looking at this type of model, as opposed to just looking at a simple table on momentum. So again, this is a framework that can be applied on various asset classes, and you can drill down to different sectors and find the best opportunities in those sectors. So let me just show you. So for example, if you're, I understand that over the past 3 weeks, there's been a rotation to the healthcare sector in the US. But the rotation to healthcare hasn't been broad-based, but if you're still interested in looking at the best opportunities there, you're better off trading LLY, WCG, IQV, SGen. Those are low risk, high reward type of trades based on this framework. You would have avoided everything else. INSY, CRON, ZYNE, PBYI, and the likes. You would have avoided them because they weren't compensating you with momentum. They're just giving you volatility. Technology, same thing. AMD, SYNT, best bets. If you're just looking for exposure in the technology sector. If you wanted a little bit more volatility, and you didn't particularly care if you're going to be compensated, then you can probably choose TRIP, Twitter. Those are more volatile pairs compared to SYNT and ANB. But if you're very conservative, you want momentum, you don't want the volatility, but you want exposure in the sector, then MSI, GIB, INFY, those were your options. And again, just go through the sectors, find the best opportunities. It will always be the same story. It will always be a trade-off between momentum and the volatility you're willing to assume for your trade. You just need to find the pairs that are that will provide you with momentum efficiency, rather than just arbitrarily choosing which ones have the highest momentum within that particular sector. So I hope that's clear. So just to summarize, momentum strategies can be as simple as ranking securities based on 12-month change or their year-to-date performance. These models, they help us buy leaders, sell laggards systematically, and that's the word. That's really the concept, to systematically do the stock selection, the trade selection process. Now, a powerful extension to the simple ranking models is to rank in terms of short-term and longer-term duration. You see, while long-term momentum can help us identify the big picture trades, you also need to be wary of what the trades are doing short-term. So you need to look at shorter duration momentum. It helps us avoid consolidation. It helps us identify possible momentum rotation away from current leaders into newer ones. That's why we do multi-duration. Using Scatterplot models to analyze momentum can enhance trade identification. You're not putting too much stress on your trading system, forcing it to churn out for you the best possible trades, because we're using a separate model for trade identification. Finally, we showed you that it's never just one thing. While simple momentum ranking models will always tell us which trades are efficient, the relevant approach does not take into account volatility. We just know about momentum. We rely on our eyes when we inspect the charts to tell us whether a trade is volatile or not. But if you combine momentum and volatility in a unified framework, the process becomes much easier. It stops being about trade selection. It no longer becomes about trade selection. It's not about that anymore. The workflow becomes about looking for ideas that capture the traits and characteristics that can give us the best possible risk-adjusted returns. So with that, thank you very much. And let me know if you have questions.
All right, Jed, that was really a fantastic presentation. I totally enjoy what you shared about using the different momentum as well as the volatility and the Scatterplot ways to identify potential stocks or instruments to look at trading, or let's say investing over a longer position, a longer term time frame. So I've just some questions here. We don't have a lot of time, but there's some really questions that I really wanted to ask you. So towards the initial part of your presentation, I remember there's this part that you say that like micro caps and small caps, when you studied based on your research, it seems like within a year or whatever that they can actually increase by a big percentage of returns. So does that mean that easy and straightforward way is to generate higher returns is to just look at the leaders in the micro caps and the small caps? That would definitely make a lot of retail investors look towards that direction, right? So is there any downside or things that need to be aware of that in terms of selecting micro caps, small caps, or the bigger caps ones?
Right. So you're right. So one of the findings of the study is that if you want to generate more returns, you tend to move away from the larger, more prominent names and move into more speculative ones, small caps, micro caps. That's the way to go. But the way to go about it is once you know that you're going to get into small caps, micro caps, you need to have a trading system that can trade those more volatile pairs. Remember, the returns that we're discussing, the 200% return to 400% return, that's just one aspect of the equation. That's just the returns. What's underlying those returns are really the risks that you need to take. You need to define for yourself if you can take on such risks.
I see. And so one question for you is that, let's say at the start of the year, the first week of the year, I want to look at getting into new instruments and new stocks. So we still don't have that momentum plots and the scatter plots out yet. So how do you actually go about, or do you suggest that you should just avoid the first few weeks of the year and just hold on until things start to emerge a bit towards the third week and the fourth week before you start looking at potential trades?
Right. Well, the way we do it is we really map it on a daily basis and map it over the first 3 weeks of the year. The first 3 weeks of the year, you get a picture already of which ones are outperforming and whose momentums will be the ones that, and themes will be the ones that carry through over the next 3 months.
I see. And so just now, during that plot itself, it seems like the general suggestion is that focus on those leaders that has a year to date has progressed a lot. Let's say if you're looking for buy ideas, year to date progressed a lot, and within the past 1 month has progressed a lot as well. So is there a risk of, if you just focus on those instruments that has that characteristic, could you be like end up buying at the tops or getting in at the tops, especially considering that it has run a lot for the year and it has run a lot for over the past few weeks to a month as well?
Right. Good question. So 2 things. The first thing that you need to understand here is that the role that benchmark returns play in helping you determine whether you're buying the top already. So for example, in the Philippines, if you're a large cap investor and you're trading blue chips that are already up 30% for the year, then in all likelihood, that's already the top for the year. So no need to buy stocks that are up 30%, unless you're able to pick those that were able to break that 30% return, and they can generate another 20% to 30% for you. The other thing that you need to understand is that financial literature has already established that things that are in a trend over 3 months will stay in a trend over the next 6 months to 9 months. They will stay in those trends. And only after the 9th month will things become choppy, at least for stocks. That's generally been the case. So anything that's in a trend in 3 months will be in a trend in 6 months up to 9 months. And then it starts trading choppily.
I see. And how about this? I was just thinking about the concept about that, right? So how about if we look at stocks, for example, that has performed very well year to date, and then focus on those that has actually retraced, or let's say has been pulled back in a negative way over the past 1-2 months, and looking at getting into those stocks, because if let's say it is in a usual wave movements, the pullback, it will actually start to reverse and continue on its long-term momentum thereafter. So is that a possibility as well in terms of picking stocks to buy?
Right. Well, the way I do it is once I know which stocks I want to buy, I usually define the ranges for these types of trades. So it's all about where prices are relative to my big picture range. So define the range and see if it's trading above the midpoint of the range. If it's trading below the midpoint of the range, then that's probably a stock that's too weak to trade anyway. So that's how I generally approach it.
I see. So usually, if I could just dive in a bit into your workflow. So let's say you have used the momentum of the model, you have taken a look at the volatility versus the momentum as well. So you probably will be looking at a few instruments that you think is highly potential. So based on that small little list, how do you go on further to decide whether I want to enter position into all of them, or should I just enter into position for a selective of them? What is that thought process over there then?
It depends on my view of the market. When I'm bullish when my market is in a bullish trend and I have a watch list, I tend to be fully invested at all times. So whatever's on my watch list, I try to deploy as much and as quickly as I can, because cash will be an automatic drag on my performance. But if my view is that the market is in a bearish phase and I have a watch list, I tend to be very selective about the levels. And I just try to trade a portion of my portfolio rather than being fully invested, rather than trying to rush into whatever names are on my watch list.
I see. So if let's say, for example, let's say right now is, let's say, for example, February, I have the data for the past 2 months already, and I generate based on your models, let's say 5 stocks that looks really good, strong leaders. So do you actually invest all your money into those 5, or are you constantly 100% in the market, or do you actually hold cash? And what's your rationale of holding cash if you do hold cash and not being all in?
Right. If I have a watch list and I'm bullish about the market, I need to deploy all of my cash into those in my watch list. And I expect to outperform the market based on my stock selection process. Now, the way I actually execute is I usually if I'm bullish the market, I usually give myself 5 days to execute on the trades and be fully invested already, given my view about the market. If the market is bullish, market timing for me becomes a secondary consideration. As long as my stock selection process is intact and I'm bullish about the market, then I should be safe. I should be okay, given that I've already chosen the strongest pairs in my investment universe. This is very different from, again, when the market is bearish, I need to be very selective. I'm going to hold cash and pick my spots relative to what the market is doing.
I see. So if let's say you decide to get into a trade itself because of all these elements that you've identified and think, okay, this is probably the right time to get in, do you have a stop loss for any trades that you get in, just in case that you are wrong or the momentum decide to just reverse unluckily from that point onwards?
Right. When the market is bullish, again, context matters. When the market is bullish, my usual process is I would review my positions every 3 weeks and rebalance accordingly. So I refresh the models, I refresh my position every 3 weeks when the market is bullish. I do have stop losses on individual positions, but unless those stop losses get hit, even if a position is underperforming over a 3-week period, I will only get rid of it on the 3rd week of the review.
I see. So even if, let's say, it touches your stop loss, you wouldn't get out until that 3 weeks is up, right?
Right.
I see.
It is very different in a trading environment where the market is bearish. I have tight stop losses and I'm not fully invested in the market.
See. And how would you size your trade then? I mean, let's say, how do you actually distribute? Do you distribute all the trades equally in terms of the capital base that's put into it, or do you have a certain methodology in terms of sizing your trade for individual trades that you get in?
Right. Simplify, I just equal weight everything.
Or just equal weight everything.
Mm-hmm.
And so does that mean that you actually do your portfolio rebalancing like every 3 weeks kind of thing? If let's say this particular stock has outperformed a lot, do you actually take it out and readjust and put it to the rest that is like not performing as well? Because that stock will become like a big part of your portfolio.
Right.
That's gone up a lot. So is that what you do to rebalance and distribute to the rest to make it equal again?
Depending on my view about the outperforming issue, I would tend to keep the position. If it's already trading at the top end of my range during my rebalancing period, then I trim some, put it back to its original size. But if it's not yet trading at the top end of my range, I'll let it be. I'll just yank out the underperforming and replace it with other potential leaders.
I see. So is there any downside or risk or things that a trader or investor need to be aware of when actually using this quant model and visualization model? Because my personal belief is that there's no strategy or no model that is perfect, that is the best, because there's always pros and cons to it. Obviously, you want to use a model that has more pros and cons that gives you an edge, right? So what are some of the downside or the risk elements or things that a trader or investor need to be aware of when using this particular model to make their decision?
Right. Well, the first thing that you need to pay attention to is the context of the market, whether the market's bullish or bearish. Even if your market is bearish and you're trying to trade momentum, then those type of momentum trades, the leaders will tend to have shorter duration, shorter lifespan. So you need to pay attention to those types of situations. Otherwise, you're trading momentum incorrectly in a bearish market conditions. It really depends on what the market's doing and whatnot.
I see. So correct me if I'm wrong. Even before you actually use this model to look at a watch list of individual stocks or instruments, you should actually have a take on what is the broad market trend right now, right? So if that's the case, do you actually also plot the main index using this model and this visualization as well to get a gauge of how is the broad market performing in order to even drill down to this smaller watch list?
Right. Well, you actually have two ways. You can do traditional technicals. You have simple rules wherein you're only engaged in the market if it's above the 50-day moving average or above the 200-day moving average. The other way is to, again, use the same relative performance table and just to count the number of stocks that are positive versus the number of stocks that are negative. And that should already give you the health of the market and whether your momentum strategies will work under these conditions.
I see. And finally, there is this saying or opinion of principles that getting in a trade is not nearly as important as when you get out. So based on what you have just shared, it is really more about getting in. But how do you have a model in terms of when do you get out of those individual instrument or individual trade? I mean, you can't possibly wait until they become a laggard back into the lower 30% before you get out, right? Because that means that you will lose all the profits that you make. So how do you actually decide when to get out of each individual trades then?
Right. Very good question. I always tell my students that in a bull market, market exposure is more important than market timing. You will be the market will leave you behind if you're too obsessed about your entry levels. Now, again, the way we go about it is, even though we have this process of rebalancing every 3 weeks, we do trail our stops for individual positions, such that when the trail stops get hit, we get out, even if the rebalancing is 2 weeks later on.
I see.
The only solution is trail stops. The other solution is to put together a range and then sell some at the top end of the range and then reposition on dips.
I see. And what would be your parameters or sort of like generalization of how do you trail? Do you base on a technical trend line or moving average or something of that nature? Or is it purely based on data and quantifiable numbers?
I use candlesticks.
I see.
Basically, I use candlestick opens every 3 weeks to define whether the stock is topping out and where my stops are.
I see. And let's say if it hit its trailing stop and you got out already, is there any possibility that you might get in again, considering that if it's still a leader and it is still showing signs that it's not actually reversing down yet?
I usually wait for it to calm down before I reposition on the stock. When I get out, I need to reevaluate the position again because my stops are pretty liberal as it is.
I see. All right, great. Jed, I think it was a really fruitful discussion. I wish I have more time to chat with you and to understand more from you. So I will definitely have try to arrange for some other interviews so that we can dive deeper into your concept, the way you think about trading and investing in the markets. But meanwhile, thanks again so much for the time that you have taken to spend in this summit to share your vast experience and knowledge with regards to this model. And I wish you all the best in whatever you do. And I'm sure the summit participants will be very grateful for what you have shared.
Thank you very much.
Right. Thank you, Jed. See you. Take care.